And yeah, we were just chatting in the break with our next guest about a couple of those names on screen there. Goodman Group, came out with an operational update yesterday, being punished again today. And James Hardie is also down by about 4%. And maybe that is, Scotty, where we can start with Martin Crabb, who's joining us from Shaw & Partners. Martin, welcome.
Good to be here.
Did James Hardie deserve the treatment it got today after what seemed to me, at least, a pretty positive update?
Oh, I didn't think so. I mean, they grew their profit at 30%, and they guided to, and they came in inside the guidance that they'd set, and they reaffirmed their guidance for next year, which is for pretty strong growth. It's another 25% up. So it's a company that's growing 25% per annum. It's on a market PE. It comes out with a set of numbers in line with the market and maintains guidance. In a normal market, that goes up 4, not down 4. So. And like you said, Goodman yesterday, those numbers weren't that bad either, but I think people just come back to looking at valuation and going, well, I don't really want to own growth stocks right now, so anything on 20 times current earnings, even if it thinks it's going to grow next year, I'm just cautious. So just this big growth sell-off's continuing, but fundamentally, the market's sort of going 180 degrees in the wrong direction, whereas kind of last year, it didn't matter what you reported, your share price went up. This year, the market's a lot more discerning.
What parts of the market are interesting you at the moment, given everything that's going on at the moment? We've got the RBA minutes that were out today, of course, and maybe a little bit slantish towards the hawkish side, talking about potential grounds for a 40 basis point hike last month, maybe one we might get this month coming up in June. Is that maybe explaining some of the movements we're seeing across the broader market?
Yeah, it's interesting that the Reserve Bank board toyed a lot more with 40 than the market thought. And the minutes sort of revealed that 40 was a real live thing. And some people say, well, maybe a higher rate hike is likely going forward. So they're not just going to stick to the, quote, business as usual 25 points. Maybe they're going to go a bit harder. But the cash futures are sort of selling off or rallying, depending on your perspective. So the market's outlook for interest rates is for lower interest rates now than maybe a week or even 2 weeks ago before the board meeting. So they're now looking like peaking at about 3.25. Similar things are happening around the world. So we seem to be past peak inflationary expectations. So if you look at the CPI-linked bonds here or the Treasury inflation-protected securities market in the US, you can determine what the market thinks inflation is going to be. And they've been coming down. So that's given the equity market room to rally, because maybe inflation is not going to be as bad. Maybe the central banks don't need to be as tough on rates and slow the economy down. So maybe we should rally a little bit from here. So sectors that are exposed to that thematic seem to be doing quite well. So rebound in the miners today, and obviously that's ahead of a conference tonight, which should be interesting.
Yeah, all the big miners are having a big party in Miami. And it's the Australian guys that are there as well, guys and girls, I suppose I should say. BHP, Rio, also global miners like Vale. So I spoke with Peter O'Connor, the metals and mining analyst at Shaw & Partners, just yesterday. Yeah. And he was saying that often from this conference you will get tidbits of information that can help fill in, I guess, some of the colour in the picture. Yeah,
the fact that you got a couple of the big iron ore guys going up early, and also Freeport, I think, which is a big copper producer, they'll set the tone. So the conference goes for 3 days, I think, and there's something like 60 or 70 companies in total. So you get a pretty good picture on what's happening. But anyone who's done a site trip to WA or talked to mining companies, and Peter organises a few of them through our offices here in Sydney. They'll say the same thing. Costs are out of control. They're worried about climate change and how they decarbonise their operations. They're still worried about labour shortages, about heritage issues in Australia. So even though they're absolutely rolling in money, they'll all talk about how tough it is to make a buck as a miner, and how they need more government, policy controls and so forth. So, but I think it will set a maybe not a bearish tone, but just a more cautious tone that things are pretty tough in terms of running operations efficiently and getting staff and dealing with fuel costs and things like that.
Yeah, join the club, miners.
Yeah, exactly. same as the rest of us.
Do you think China might go and rate a mention or two at that conference? There seems to be a bit of excitement brewing about a potential end to lockdowns in some of those big metropolises in the not too distant future. Are you getting excited about it?
No, look, I think hope springs eternal, but I mean, China seems to be saying, look, the health comes first, the economy comes second. And even though there's the mayor of Shanghai the other day said, the lockdowns will finish, no human transmission post-May, mid-May, so it's like next week's or now. It's difficult to see that actually happens. I don't think you can control it that easily. So yeah, we're looking at the numbers that came out yesterday: retail sales, fixed asset investment, IP, all look terrible. So I think China slows a bit before the government steps in and re-stimulates. So I wouldn't be buying the dip on China stocks just yet.
Would you be buying the dip in what? Because I do note that we're getting a lot. No, I don't want to over-egg it, but we're seeing downgrades coming through.
Yeah.
Step one yesterday, that's one example, perhaps a poor example, but in some of the mining services companies, we're seeing some red flags sort of being put up. Is that what you're sort of bracing for?
Yeah.
More of that?
Look, it's tough. I think the thing I'd like to start looking at is what I call quality growth. So if we move from this phase of let's protect portfolios against inflation, let's buy lots of commodities and agricultural assets and energy to protect ourselves against that, and that's been incredibly profitable, that strategy, for the past 6 months or so. Are we reaching the end of that and it's now, okay, there's a slowdown or potentially a recession coming, I need to fill my portfolio up with high moat companies, pricing power businesses, so the Amcors and the Brambles of the world, and that's starting to become a profitable strategy. The next phase of that is give me something with growth. So the whole economy is slowing down, can you give me something with some growth? And that's where the Zeros and the Aristocrats and the James Hardys and the REAs, they are secular growth businesses. They should start looking attractive. And I would have thought that we've got Aristocrat reporting on Thursday. I think we had Hardie's today, we had Goodman yesterday. The market's not responding positively to those things. I think that makes them interesting. Mm-hmm. The fact that they are showing you that they're growing and their outlook statements for more growth going forward, well, that's what I want to own going forward. So I think the fact that these things are selling off, it's playing right into that thesis. So that's where I'm getting interested.
Okay, but you're not ready to deploy all your cash now?
No. Never deploy all your cash. Always have a little bit of powder dry.
Yeah.
But I mean, we don't own a lot of those names, okay, and sort of been out of them for most of last year. Just starting to add them back in. So things like Zero after their result, the stock got hammered on that result, and again, I think the numbers are okay. So it's a bit of an odd reaction by the market, but that creates an opportunity for people to add a stock that maybe they didn't own before.
You mentioned Brambles. CVC didn't wait long to go and reboot the takeover approach. They went and looked at what was going on and walked away pretty quickly.
Yeah, they'd be pretty livid, right? So they've obviously had conversations with the board and it's leaked somehow, and they would be absolutely livid because they've obviously put a lot of effort. But what the newspaper article said was a $20 billion Aussie EV valuation, and the share price went straight to that yesterday. So, walking away. But do you ever walk away? And they've obviously done a lot of work on it. Bramble's an interesting one because it's doing a lot of capital expenditure at the moment just to keep its pallet pool up to date, and lumber prices are really hurting, but that's probably transitional. And then they're potentially looking at Costco's plastics business, which again is a lot of capex. So you can see why a PE buyer goes in there and says, we just got to hold the capex back and let the cash flow run on this thing, because obviously the pallet pools are incredibly valuable as we go forward. So I wouldn't think that you rule them out. I mean, the market said today there's no bid. Yesterday there was a bid. We're somewhere in between the two, but I wouldn't be surprised if someone comes back and looks at it again, because obviously the board has indicated that they're not throwing it away. They said they're in discussions, preliminary, but maybe there's another bid to come in Brambles.
Okay, so if we have, even another positive day, what if we have a positive week? Should investors be reading into that as the tough times are over? We've got Jay Powell tonight, we've got wages tomorrow. Like, it certainly feels as if, would this be sort of a dead cat bounce in the midst of a bear?
Look, I think so. It's an oversold market. It's, particularly, you don't see it as much in Aussie because we're probably only 6% off our highs. But if you go to Wall Street and look at the NASDAQ or the Russell 2000 or something like that, they're down 25 and China's down 50, right? So a lot of the world's been absolutely built. We haven't felt it that much. But the things we look at are growth. Is it slowing or accelerating? It's slowing. The financial conditions tightening or loosening. They're tightening. They're not good environments for equity investors. So you got to play a defensive hand. But given it's sold off so far and cash futures are rallying, the bond market's starting to rally, there's a bounce here. It's a trading bounce. We're still playing it from a cautious perspective. So not massively underweight. We've started to put a bit of money into the market, but we're just going to see a trader's bounce, I think.